But it has been far too long since I've had you on the podcast, my friend. And
great to be back.
I am stoked to discuss a host of things. We've got 6 main points that you sent me to review, and they're kind of all over the place. You've got we're talking energy, COVID normalization, autos, healthcare, and then some thoughts on 2. I wouldn't call them like special situations, but I feel like one of them is this business transformation, and then the other one is just this crazy reflexivity story in Leslie's, which I remember finding Leslie's on like a Left 4 Dead screen, and my buddy Unemployed Value Degen wrote it up, and I never bought it, and now it's done this crazy like 10x. But we'll get to all of that. But before we do, you've got a disclaimer you need to pump out there. So
this is for discussion purposes only. Nothing should be considered investment advice. Some or all the securities we're about to discuss may or may not be suitable for you. Consult with an investment advisor before making any investment decision. Investing in the market contains a series of risks, including especially the risk of loss. Some or all of what we're about to talk about may or may not be true. Do not rely upon it for any investment decision. Nothing in this discussion is about forming a group or grouping under 13D or G rules. And everybody's free to trade. We're public market investors, and I have no material non-public information. So there we go. There, Mr. Lawyers.
Start your engines. All right. So I think the first thing is you've had
Before some sort of the first thing. I think we get to do like a first thing.
Yes, let's do the first thing.
Well, let's start with just what I'm doing, and then we'll do the first thing.
Yes.
So I have launched Lake Cornelia Commentary Substack. I went away for a little bit last year, and then I came back. I went in-house for a client and realized I like being on my own. So you can find me online at Lake Cornelia Commentary on Substack, or still on Twitter under Lake Cornelia. And we still have the client business with a few people, but most of what I'm doing is running my own money and the Substack. So it's been nice to be on my own and go through that midlife quarter life crisis of realizing being on my own is what I want to do. And is
that just a personality thing? Being on your own, not wanting to work with. I mean, not work.
I think it's also like time of life and age. Like I worked at 3 mega hedge funds, and then my team spun out of the last one, and we launched a hedge fund at a big asset manager. I just think I sort of have had my fill. The guy at One Main, Yaron. He said on a podcast, I think earlier this year, last year, that like at some point, investing becomes a deeply personal experience that like you just have to do it your way. To me, that was, when you're younger and you disagree with those around you, you're like, well, they have experience and whatnot. You get older and you disagree and you're like, I don't know if because somebody who's better than you, like you're talking, especially within something that's in your zone of expertise, the mega hedge fund managers of the world that are just awesome. And I'm never going to be one of them. They can do 95% of what their senior analysts can do. And they can do that across every sector. And then on risk management and sizing, they're probably a little bit better. But when you isolate just to like a one-on-one stock discussion of a name that cold, the probability of them bringing up something that like really makes you think as you go to older, it really shrinks. And you want to do what you want to do. So I think that's part of it. And then there are obviously, the confidence to be on your own and the financial aspect of being on your own too becomes incredibly relevant. So, it's nice. Who knows what tomorrow brings, but I'm having a ball. Like this year has been, easily my best year since I've been on my own, which started in February 2020. And so it's nice to be it's easy to be happy in a good year. So,
So what do you think, besides obviously getting the stock picks right, what has made this year the best year? Like what conditions were present to help you have the best year possible?
I think it's a bigger evolution than anything like this. Like, going on your own, a lot of things change. It goes without saying, but one of the biggest dynamics that changes is you go from a world where you're essentially fixed universe and with all these constraints, you can only pitch that which is going to get in the book.
Yep.
The constraints of what gets in the book is partially impacted by the risk managers and also the person who runs your group. and the realities of running LP capital and whatnot. Okay. When you're on your own, you have the whole field. And like, look, I don't have, I'll admit, I don't have 5 billion or 10 billion or 20 billion dollars. So like, you know, what's relevant to me and what can be impactful is just fundamentally different. And so I talked about this a little bit earlier this year with Andrew on his show, which is one of the mistakes I found I was repeating over and over again on my own, was being too cute by half and getting these names that were less liquid and that people didn't care about. And I was waging a war almost to get people to care. And what you trade with those names is you get valuation obviousness, you know, because that's why, you know, they're attractive. They're less liquid, but you lose the liquidity and you lose sort of this upside optionality of something that people can care about, and you're going to get flows and you're fighting for flows. Where if you go one level up from that, you start with, okay, people already care about this. And if I'm right, and sort of not dismissing valuation, but cadence and momentum and all sorts of other things are as important. And said differently, great businesses almost never look optically cheap. You know?
Yeah.
It just is what it is. And they look cheap in hindsight, but not in foresight. So, you know, there were a few big ones historically, you know, over the last few years that have changed my thinking. ASATs I missed. That was a big one where I knew people would care. And the fact that I missed it, especially once it had its definitive moment, the stock was, I think it was at like 3. It ripped to 5 on the big announcement that changed everything. Came back to 4. I didn't swing at it. And, you know, it went up to 40 within 6 months.
What ticker is this?
ASATs, ASTS. But that was one that was sort of, you know, a special sit, and it was like, it was a busted SPAC. Could it be interesting? Nebius, that's NBIS, was one I was all over. I didn't maximize.
I was about to say, I think you came on my podcast and you had pitched Nebius. Like,
yeah, and that one, seeing it work, you know, it's just sort of reinforced and it clicked. And I'm like, you know, that was one where like it really didn't optically cheap, but everything else clicked, which is the CEO was awesome, the story was awesome, the space was awesome. You knew these guys were going to execute. So, you know, and that just moving away from that stuff and making sure that I'm in stuff that people care about. And we'll talk about this a little bit later in our show. And it's like one of the ironies is TOI, the Oncology Institute's my biggest position. It's been, you know, one of the biggest winners, if not the biggest winner of my life. And, you know, I got involved, you know, initially in 23, left in 24, early 24, because I didn't like what was happening. It bottomed in late 24, and I came back to it, started rebuying it like 25 cents and got my whole position on at 70 cents.
Oh my God.
And now it's, you know, north of 5, and I think it's got a real chance to go to 30. But like, that's one where I look back even today, I'm not sure, like with the evolution I made, that I don't know if it was like, I wouldn't do that again. It was so illiquid at the time, and I was literally over my skis, and I think there's easier trades to be had. And we'll talk about AGL, which is my biggest, a huge winner this year. And Leslie will go through and a few other ones. But I think making sure that I'm in stuff that people care about and that is already liquid or close to liquid, is a big thing.
Well, how do you do that? How do you kind of shift from making sure that stuff is liquid enough that people will care, but also maintaining the core pillars of like the reasons why you found those ideas, like how you found TOI at 25, 50 cents, how you found AGL down at 3 to 4, like how you found Leslie where you did. Cause like that to me is the most interesting part, where it's like, yes, I understand you can kind of scale this to have, you know, some sort of liquidity constraint, but like there's a process behind all of these. And like there's similarities between AGL, TOI, Leslie, when you look at it.
Let's go to Tidewater, because that's the other one that really illuminated this for me too. Because when you're young, you don't appreciate setups and how long they take. I started in the hedge fund industry in 2005, November 2005. I started in finance in summer 03 at Lehman, you know, went back full time. I was in the power and utility group. And in the power and utility group, and then I was the power utility guy at my first hedge fund, King Street. And I worked on the Calpine bankruptcy. It filed a month after I joined King Street. And it was, you know, you're buying distressed power plants. Those things, at the moment, I was like, oh, this all exists because of the Enron boom bust, the TMT bubble, all this stuff got built out. You had El Paso, Dynegy, all these names, Duke Energy. Most of these things are still around, but like different forms and different iterations. But like something happened years ago. There was a loss of capital restructuring. Now we're finding cheap assets years later as things change. And like, because at a foundational thing, what I found is like my best trades are when I buy value or, a value situation and I sell a growth stock.
Yeah.
Because I think too many people, and I say this as a person who started as a distressed guy, too many people focus on, I bought something really quote unquote cheap. It doesn't matter. Like you can make a little bit of money. It's like value stock investing. Great. I bought a portfolio of 5P stocks. Yeah. I bet you the ones that make the most money are the ones that the earnings inflected, not the driver is that earnings inflected, not the one that like, oh, I scalped somebody. I bought a 5 times P business. I bought it at 3.5 times. Then I sold it at 5. That's just a miserable way to live. Like you want to buy stuff that just fundamentally changed. Look at I don't know if it's the best private equity deal of all time anymore, but like it's certainly top 5. Apollo buying Lyondell debt in the financial crisis. They bought it at EBITDA 0 or negative EBITDA. And within a year and a half, because of the shale revolution, so your chemicals is super easy. You're short Henry Hub, you're long Brent oil. And that spread just massively blew out. And they made over $10 billion on almost nothing. So yeah, a perfect example of like something starting distressed that became just incredibly interesting because of like what happened. So you need to call these inflections more than anything else. And so it goes back like with Tidewater, you and I talked about that at length, and you can do rig, you can do all this stuff. Like the seeds of that started in 06, 07 with offshore really mooning. Yep. It didn't really struggle during the financial crisis. Then we had this massive building boom of rigs, and you can extend this to ships because Navios is another position I still like. This building boom through 2014, and then the OPEC bust in November 2014, and it went to 0. And how many people went broke or lost a ton of money from 15, 16, 17, 18, 19, 2021, trying to call the bottom in shipping, offshore, all that stuff? It wasn't until demand came back that this stuff became investable. And so Tidewater, what was my pitch coming back? This was at like 17 a share. The stock ran up to 18, 110, I think. And then it came back to 25. And now I think, where are we? We just bounced off of 80 again. Now we're 60. And it's
66.
But again, like the whole story isn't that like that bet was available for a decade. That you could buy ships, OSVs, or rigs for 20% of replacement costs, but it's not an investable situation or that interesting in any meaningful way until you get the demand story back.
Mm-hmm. Well, so let's go through these examples because I think we'll be able to kind of weave in the trade.
We got to do energy first.
Yeah. So let's do energy first. And again, this is one of those trades where I think anyone in commodities, myself included, like going into this whole thing, if you would have told me all the things that had happened and then told me where oil would eventually trade, I would have, been like, oh my gosh, like this, there's no way that could happen. But yet here we are at like, I think we're 70 or maybe sub 70. And it's just destroyed all the oil bulls. Like all the oil bulls on Twitter are just destroyed.
I have this thing, and this came out of the financial crisis, and it really clicked for me during housing in 09. So I'm sitting at, a great distress fund called King Street. It's still around. And like it had made money in 08. Like saw the housing thing, just unbelievable risk management. The PM at the place, just one of the greatest hedge fund investors of all time. He's retired. The other guy's still there. The organization's doing great. But he sort of presses, and this is what I took away, not necessarily what he was saying, which is you'd hear by 09, obviously everybody was an expert in housing. You couldn't exist, like every data point was known. And there were all these bears there. And he sort of like poo-pooed it. He's like, no, it's just time to get long. Like it's all out there. Like the price action is low enough, and it's telling you like we have bottomed. And like whether we get the bull case or not, at some point you can only be a contrarian on a macro and overrule price action in the beginning. Every day that goes on with a macro change, like a major macro thing that goes on, the price action becomes more and more true. So, like about 2 months ago, I just got really bearish on energy in the middle of this thing. I'm like, well, here we are. Like, and to your point, all the people were doing the math and all this stuff. And there's two types of people who are energy sector heads and hedge funds. Most of them are math freaks, and they have all the math, and that's the way they defend themselves against their PM. And I was like a low case, mid case, high case guy that never wanted to commit to anything because I was just let me just step back for a second. Being the energy guy is the worst. It's one of the worst jobs ever. You're going to look like an idiot constantly. Your sector correlation is super high. So you either have all these buys and no sells, or you have all these sells and no buys. The PM can't, especially if the PM wasn't an energy guy, can't differentiate. So it's like the tech guy and the TMT guy is like, here's my 5 buys, here's my 5 sells. And they're going to be their standard deviation of the variance of like their calls versus reality is going to be really, really tight. And they're always going to have this balanced pitch thing. They also have a plethora of opportunities constantly, so they don't get attached to things. As an energy guy or a commodities guy, you have 1 or 2 things that might be interesting on a 3-year basis. So you anchor, you defend it to the hilt. Yeah. And then you're like fighting this constant macro game that, like, at Citadel, they'd say like there's a transient factor. It's like, yeah, it's not a transient factor. It's like a big oil price move. There's no hedge for that. Oil goes from oil in a range you can hedge from, at the money volatility, but like oil moves from like 60 to 90. The first, second, third derivative implications are massive. You can't, it's just like a regime change. So I never loved doing the more macro a thing gets, I get very leery of precise estimates because I just don't think you can do it. And with this, like this being the oil thing going around, I just was like, all right, well, this is it. I hear what the math guys are saying, but like maybe China, like I don't know how much oil they're sneaking out, but like you can't for 2-3 weeks say I'm right. The price of oil, literally one of the most liquid commodities of all time, in the middle of one of the most liquid things, or liquid moments. Like it's not even about arrogance. It's like arrogance that you're going to overrule it. It's just like as time progresses, the price is right. And then you need to think through what's going on. Now, how we've left, this Iran, I'm calling it Iran War 1 because I'm firmly convinced you're going to have Iran War 2. This is like a Versailles situation where we're leaving Germany, in this case, Iran and the Gulf states in a situation that's just bound for war. Like in the short run, Iran's going to pump a lot of oil and also take tolls on Hormuz. That's untenable for the Gulf states to pay that forever. They're going to have workarounds and whatnot. But, you think about oil right now. Okay, Venezuela's massively outperforming. Now we'll see what this earthquake does, but it's clearly massively outperformed. I don't know if Iran sort of dwarfed the Venezuela thing. Venezuela would have been the news in the oil market if it wasn't for Iran. We're going from 1 million barrels a day to maybe 4 within 3 years. I mean, what these American oil services firms have been able to do, not shocking. It's shocking to all the experts who said you couldn't ramp up Venezuela production that quickly. Like, they're ramping it. So that could be 3 or 4 million barrels a day. UAE drops out of OPEC and is building more bypass pipelines. So 3 is probably going to go to 5, 5.5, or 6. And they left OPEC, so what is that going to do to the cartel, right? Iraq rumored to be leaving. Iran is going to get a lot of investment and is going to ramp up production because they need the money. And we just dropped dollar sanctions on Iranian production and sales. So you ramp all that up, and I don't know where the Ukraine, Russia war ends, but like OPEC, plus production, we might be talking 7, 8, 9 million barrels a day of growth on a 105 base for the world, 105, 106 million barrels a day, over the next 2-3 years, just from OPEC and OPEC plus. Like, that is the most bearish thing ever for non-OPEC production. It's terrible for offshore investment because why would you take long duration investment risk? The U.S., it seems Trump wants to produce more in the U.S. as a geopolitical weapon, so I look at energy and I'm like, I just don't, it seems very bad to me. And we also saw the ultimate, the pricing maximum, the worst possible thing happened for supply and prices only went to like 110.
Yeah. And I think that's the biggest thing is my biggest realization is at the end of the day, like price is king. And like, Alex and I have a saying, price is truth. And, especially in what you said, like one of the most liquid markets, one of the most, one of the largest commodity markets globally. When you started to see oil just kind of fade 100 and just keep making kind of these lower highs, and everybody was screaming like, oh, oil has to go to 150, it has to go to 200. And the price action was just disconfirming that hypothesis day in and day out. Again, hindsight's 2020, but like that's something where if you kind of remove your bias and remove your anchoring, like you say, like you could probably make the argument that, oh, you know what, maybe I'm missing something. And maybe the price
from a process standpoint too, it's a really good point. And this comes out of being a distressed guy because you're always looking at bonds, right?
Yeah.
And both of the first two funds I worked at, the second one was called Anchorage. It still exists. The founder left and it's reincarnation, but founders came out of the Goldman Special Situation Desk. They're even more so than the first place. It was this huge focus on explain the price today. You've got senior bonds, you got first liens, you got unsecureds. What is every single guy? How do you get to the price of the securities? You may disagree with them. We're going to get to that. But like, how do you get there? And you'd oftentimes find these situations where you'd say, or I people working for me too, where they'd be like, look, I can't get to past 70 cents. And I'm like, well, the bond's at 95. So if we can't even conceptualize what, like, we're off by like orders of magnitude here. Like,
yeah,
and it would happen to me too, to a boss. The younger you are, the more you think you're right, which is, a you thing. You get older and then you get too humble because you've been humbled so many times. So you go the other way, but you got to go both ways and really understand it. So, when to your point, all the oil bulls screaming like the price is wrong, up until even 2-3 weeks ago, I'm like, well, how are we, like, what's more likely? Your spreadsheet's wrong or the price is wrong?
Yeah. So how do you see the next, call it 12 to 18 months unfold in the oil market? Like, are you even touching it? Are you scoping it out? Like,
I thought the only thing that was buyable and I'm just talking the equities. I'm not talking the commodity, right?
Yeah.
I thought the only thing potentially interesting coming out of this was the LNG names, because Qatar is like 20% of global export capacity, and it's really the base load. So the biggest buyers of LNG are Japan, Korea, and Asia, because they need it. And if they need to get like backup / redundancy, the only place to get that is the United States. So that's super bullish US LNG, and you can express this through VG. You can express it a little bit through Cheniere, and maybe Next, right?
I was pulling up Cheniere's chart. It's actually kind of nice. Nice little pullback here.
Yeah, but the problem is now you look at this and it's like, well, I don't know if that's true. Like, Qatar's probably going to come back online sooner than they think, because it always happens sooner when it's that critically important.
Yeah.
And if Hormuz is just going to be, if Qatar's going to be in on it, like their LNG tankers are going to get out of Hormuz, maybe that's not as good, and maybe none of it matters because oil's just going to 50, and that's just, and in that case, like the best house on a bad block is still a terrible house. GLNG is another one that might actually get a ship into Iran, but it just doesn't feel like I want to touch anything in the sector. And I think my base call has been on my Substack has just been, let's see where this stuff bases out. You don't have to touch it. Like, the real good thing is oil's going down. Interest rates are going down, and those two things are very correlated. And boy, is that all of a sudden the most awesome thing for literally everything except energy and commodities.
Yeah. Yeah, no, well, and it's, then I wonder if you could also make the case like oil going down, interest rates going down, like eventually that could become the bedrock for the next like precious metals bull market. Because I think you also have the similar kind of anchoring mechanisms and biases, which I fully admit I did. We made a correct call in late 24, early 25, early to mid 25 on gold and silver, and it worked really well. And I got anchored to that and did not let go of that thesis for a while when the price action was clearly telling me that something had changed. And so now you have gold down 30% from its highs. You have silver down, gosh, I think silver is down like 50 something percent from its highs. Is that a space, precious metals, that you like partake in?
I don't touch it. I mean,
Yeah.
silver, you've got obviously the AI thesis with data center. Gold went parabolic. I don't know enough. I know, like in my world, I'm like, okay, oil, I can take a view on that I feel reasonably sure, but I'm taking it via stocks. And I just feel like in the short run, for the reasons I mentioned, I just think OPEC production between Venezuela, Iran, UAE, maybe Iraq. I just think they're going to pump like crazy. And
I remember I remember selling I had some physical silver back, started buying it like in the 30s. And, I remember tweeting that I was selling it in like the mid 80s, and the response on Twitter was hilarious. Everybody was like, "You're so dumb. You're so dumb for selling. It's going to 150. It's going to 200." And I was like, "That should have been the tell."
All this stuff is like Bitcoin, like from a trading dynamic, which is especially when I started in this business, it was like this legend of the gold bugs. And like the guy I worked for was like the gold bugs. And he did not mean it in a positive way. Cause at this point, like, this is like 03, 04, 05. And like, he's talking about guys who like hit max bullishness. Like the price action was great early 80s. Then it collapsed and it didn't start rallying until after, 06, 07. Right. And so he's talking about guys who've held a view, been wrong forever, but are like, super convicted that they're right.
The dangerous combo.
And then when you get the price reinforcement, obviously, like the biggest mistakes I've made in my career have been to a name almost securities or commodities that I had a view, I made money right away, and then I let the price action dictate, and then I stayed with it way too long.
Yeah, that was me last year into this year. So let's go to so we'll put oil and energy aside as something that's just too complicated right now, and maybe we'll revisit it like sub 50 or around 50. I think that could be interesting. What I really want to discuss is this whole COVID normalization thesis. We have turned pretty bullish biotech and healthcare. Most of it thanks to people like yourself and a couple other smart investors that have kind of pounded the table on healthcare here. So walk me through that whole COVID normalization thesis, because it's not just healthcare. You have these things like pools and autos. And one of the things that you've been, kind of vocal about, which I haven't seen other places, is this whole used car cycle thesis. So maybe we'll start there as the wedge into COVID normalization.
Yeah, the COVID normalization thing was really, I came up with it later because I realized that all my theses, or most of them, really tied to COVID. And this just goes back to our early conversation, which is setups take time. And most of the COVID stories, and we'll walk through this, are stories of, oh my God, COVID happened and we're printing money. Then we had the supply crunch and we had X capacity come to meet that supply crunch. Yep. And then then interest rates and the world fell apart and the world changed and we got normalization, right? So are you still there? Did we break up?
Sorry. Oh, wait. Yeah, I'm still here.
All right, you froze. So I came with that later, but so used cars is a simple one. So you can look at the Manheim used car index. You can Google it online. Cox Automotive does it. And it's the price of the average, I don't know if it's like a 5-year-old, 7-year-old, 8-year, whatever, used car. During the financial crisis, so 07, 08, 09, 10, used car prices went down for 1 year and came back. Auto ABS was actually left COVID left the financial crisis as like the clear winner of an awesome asset, because people, when pressed, like give up your house or give up your car, they kept the car, slept in the car because they needed the car to get to work.
Crazy.
And so, from everything like that, naturally the credit guys in the market are going to overdo it then. And then auto ABS is going to ramp, and then blah, 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 blah. Then we had the big problem. So COVID, you had this surge in demand as people de-urbanize, leave the cities, go to the burbs. Now everybody needs cars. Age of average used car went, I think, from 8 years to 12 years from 2020 to today. Age of average car on the road. So a 4-year increase, which is crazy, because what happened was used car prices went up about 60% between 2020 and late 2021. We didn't have enough car production. Yep. Then you had the disaster, which is you had a 3-year period that just ended where used car prices declined. The Manheim Index declined a cumulative 25%. So think about making a car loan, right? The car's going to depreciate. It's going to happen, right? You have this curve. You're going to do some stuff. What happened? You had interest rates went vertical and depreciation went down. So your borrowers got screwed. And the way subprime lending works, it's sort of, all right, and this isn't just autos, okay? This is just general subprime lending, all right? When the economy's good, your good people prepay, your bad people don't default. So you make all your money because nobody defaults. In a bad economy, the good people don't prepay, the bad people default. But the good people, because they didn't prepay, you get to make that like 12 to 15% interest rate on them for 5 years, and that's how it offsets.
Yeah.
The nuance with COVID that blew up Affirm, Upstart, literally the entire subprime space, was because of COVID stimulus and interest rates, that those two things going up. COVID stimulus meant all the good credit, you had all the good credits prepaid, and the bad people, the defaults were still massive. And then with autos, it was even worse. Your collateral, your residual value ended up being way worse.
Mm-hmm.
So, and then the other piece that really impacted COVID, and this just goes back to sort of the price surge leading into COVID. And this is sort of where the COVID normalization thing comes too, which is you can look through Ford Motor Credit. They publish financials. It's not public. They give you the stat of the number of people at the end of their car lease that return the car. Pre-COVID, it was very stable, about 80% a year. During COVID, because prices surged for cars at the beginning, nobody returned the car. They bought out the lease.
Yeah.
So you think about the velocity of cars on the road, what that does, right? So it mooned used car prices, right? The OEMs then didn't need to produce. You had bad car earnings because everybody was keeping their car. They didn't see it right away, the Fords, GMs, and whatnot, because the demand for cars went up so exponentially because of the deurbanization. That went away. Then you just had this, and it fed on it. So now that number, so 80% of people pre-COVID returned their car at the end of lease and got a new car. Okay. Mm-hmm. Now that at the bottom of COVID, it went down to just 12% of people were returning the car. 88% of people were keeping the car, buying out the lease.
Yeah.
We're back to 50%, 50. So for that car ecosystem, think about it, right? If you buy a car, lease it, at the end of lease, give the car back. That car goes to a local dealer, likely gets moved around the country on a car hauler, gets moved around to a car auction site. So I'm talking now Copart. I'm also talking PAL, Proficient Auto Logistics, moves the cars, Lithia Motors, AutoNation, whatnot. If you're buying out the car at the end of the lease, you just need way fewer cars. And that age the age of cars on the fleet, I think it's not going to peak at 12 years, but like the rate of change is going to come way down, right? Because people want newer cars. And so you think about that auto ecosystem. This also impacts Carvana too. The velocity of cars is going to increase. We've seen the Manheim Index stabilize. It went positive for the first time in 3 years this year. So now we can lend more, the lending gets easier because you're more comfortable with it. So Look, I was expressing this trade through LPro Open Lending, which was my big winner in 2020. I got back in the thing at $1.25 a share, and the sponsors, True Wind and this private equity firm called Bragle Sagemont, which took it public, they rode the thing from 40 down to 80 cents, came back to 2, and they just sold it this year at 3.
Yeah.
15. And I'm just like beside myself that they took all the pain and they just gave it away. But, other plays in that, KMX just reported great numbers on their auto loan book. America's Car Mart with CRMT. I don't, that might be a little too spicy, and I think it's a line down.
$30 million market cap.
But look at the debt.
Sure,
look at the debt. You got America's CRMT, you got $600 million of ABS, then you got $300 million of Holdco term loan. Silver Point owns it. Now that one's likely a liquidation, and I just don't do liquidations. They had 150 dealerships. It's down to 95. They've got the real question is, you got $1.5 billion auto loan book. The probably net value of that, because there's going to be losses, obviously, it's probably $1 billion. So that covers the ABS, and the term loan leaves money for the equity. I mean, the equity could be 0, it could be 20. But
that just sounds too hard. That just sounds too hard.
It's a liquidate, like you want a going concern. Yeah. So that's why, KMX, which is CarMax or Carvana, or the car guys, Lithia, LAD, AutoNation, or Ally, Auto Levered Bank. This is all just normalizing. LPro is the one I like because it was a play on, they did credit defaults. You know what? It doesn't matter because they just sold the company, and I'm so bitter. I had the perfect chess piece for this, but we're gonna find Copart's the other one, which is the car auction sites. CPRT.
And that one's gotten crushed recently.
That's a super high quality business. There was a comp to it, IAA, which was like a poor man's version of it that got sold, and that was a whole corporate saga. But
so why is Copart? Because this is one of those compounder bro stocks. Why is it down 50% from its highs?
Go back to what happened with leases. Because the age of average car went from the age of average car on the road went from 8 years to 12 years. People are keeping the cars. You want the velocity of cars to increase. So at the end of the lease, you buy it out, you give it back. It's the same reason, Hertz I don't love, but Avis, look, this is like the best thing ever for Avis. Hertz I don't like because they have too much debt on it. And, the fixed charges went from, it's one of those things where you've just been distressed too long. You kick the can down the road. Peak EBITDA is $2.3 billion. They fixed charges 4 years ago were $950 million. They're now $1.7 billion. So all the value that could have been in the equity has already been monetized by the cap stack. But for Avis, think about the rental car business, right? And what we just talked about. You buy a new car, you sell it 3 years later, and then you try to earn money on it, right? So the residual value, you just went through the worst possible thing, which is residual values went undershot massively, and you almost got murdered. And that's what happened to Hertz. And that's also what happened to Avis. But now the residual values, that Manheim index is getting better. Means they're going to be right on residual, which means depreciation is going to be, correctly stated. And they could make more money. They could make money on both sides. So, Avis, I think, is the one. And Avis just picked up $700 million from Pentwater on the short squeeze litigation. I mean, Avis, you're paying, I think, 3 times peak right now, 10 times forward, for a very equitized balance sheet. And if Hertz is just going to restructure is what the answer is. But you got weak competition. It's a great way to play the Manheim. So I mean,
Copart, I'm looking at Copart.
Oh, so Copart, yeah.
They have never been cheaper over their past 10 years.
Think about it, right? Which is, you want as many people possible returning the car at the end of the lease, because that you cycle through more cars, and more cars end up in the auction site, and you're retiring cars sooner. This is the worst thing that could have happened to Copart. Just on the macro alone for Copart, it's gonna flip.
This looks interesting though.
Yeah.
So then let's go to pools, because one of the funnest stories in markets, I think, is Leslie's Pools, which went, let's call it, it bottomed at around
2021 $1. IPO at the peak, split adjusted. It went from more than 1,000 a share to $1. To $1 a share.
And since then, it has gone from $1, let's call it 90 cents, to $9 and change. It's up 6% post market.
All right,
Maybe
so
like
let's
9.
just give the simple numbers, and this is the one especially. Look, there's I'm going to say there's 10 million shares. There's really only 9, but like, so I started looking at this thing when they reported last earnings. It opened at 2 that day. It closed that day, I think, at $4.25 a share. They finally had a positive comp. But like, here's the numbers: you have $750 million of term loan. You have an asset-backed lending facility, which is against the receivables. Just call that zero, because in the off season you pull on it, and in the summer the cash balance goes to negative. So it's just a working capital need. So it's $750 million of debt, 10 million of shares, now trading at about $9 a share. So you have 90 behind 750. All right. EBITDA peaked in 2022 at 275 million, I think.
Yep.
On 1.4 billion of revenue. And last year it did 1.1 billion of revenue and 60 million of EBITDA. So you just had massive deleveraging. And the store count, look, the stores in 2019, so the year before COVID, you had 950 stores. They surged stores the last 5 years, and now they just rationalized back to 950. So in 2019, you had, I want to say 970 of revenue. And
2019, you had 930.
And then 160 of EBITDA. And today, the guide for this year is about 70 million of EBITDA. CapEx, maintenance CapEx is 10 to 15 million. So the term loan is trading at 40 cents. So the term loan is saying it's just BK. Now, look, whether I am going to stick around for the trade, whether this is a trade or whether this is investment, this is one where I think seasonality, it's got weird fiscal quarters. The next quarter ends June. They report late July, early August. It's obviously the Memorial Day thing. And then you have one more summer quarter that you make money. And then after that, you get the 2 winter quarters where you lose money. Okay. I don't know what has to happen. All right. They have to find a way to screw over the debt, and they can. The covenants are Swiss cheese. You can take collateral out of the box. You can do a coercive exchange. The debt isn't due until.
So when you say take collateral out of the box, that sounds technical. So for someone that's not technical, what does that mean?
So it's a quote unquote secured term loan. Okay. There aren't restrictions preventing the collateral, which is the whole company, from being removed and new debt being put on that new stuff. Like you can take out 400 or 500 million of debt. So how this would work, or of assets. How this would work is you take 500 million of assets out of the credit box, get new lenders to lend against that, and then you take that money to tender at a discount, hopefully, for the term loan. Like the equity bulls, and there's a few guys who filed 13 Gs on this thing. What the equity guys are saying is this: we're going to find a way to extract discount somehow. Now they've hired Kirkland. It's not a secret. Like they've hired Kirkland and Ellis. They've hired I think Center Bridge or Center View, whichever is the bank. One of them is the bank, one's the private equity firm. Yeah. They've hired the bank as a restructuring advisor. Like the bulls on this are like, every 10 cents of discount we can permanently extract from the lender group is 75 million bucks. That's $7.50 a share. That's almost the entire share price. The loans all owned by CLOs. This thing was trading at par up until mid last year. It shouldn't have been trading at par. Now I don't think it should be trading at 40 cents. But you've got the next 2 quarters, like they can raise capital to extend the runway and screw over those guys. They can do a coercive exchange, which is they can offer a new bond to holders of the credit group. Hey, take discount and get this new bond that layers the people who don't take it. Like there's going to be some element there. Okay. The other thing that's going on is this thing was poorly managed. Okay. So you got broadly new management came in about a year ago. The CFO is especially competent. He's got a really good background with other companies touched. I had a great call with him just to walk through it. So they closed, I think 50 or 60 stores. They had over penetrated. So they closed all the stores they closed weren't EBITDA positive, too much inventory. They rationalized the inventory. They have local distribution centers to even fine tune that a little bit more. That's reduced the working capital thing. The other thing about this and the big story, when this thing went public, 50% of sales are pool chemicals. And they were massively over earning on the pool chemicals. They were just charging like crazy.
Yeah.
So EBITDA margins compressed from 20% down to, I think, 5% last year. A lot of that is the pool chemicals. Home Depot, Lowe's, and a lot of other guys have come into the space. Leslie's is just totally mispriced on that. So this, starting 3-4 months ago, they were like, we have to get our chemicals in line. And the value of Leslie's is chemicals get people in the door, but we want to the pool, we want to do all your stuff. So of the 950 Leslie stores, they are within 10 miles of 90% of the pools in the United States. So they're there. It's like, this is a sticky customer base, whether it's Leslie's or whether you go to Pinch a Penny or whether you just have your local mom and pop thing. You and I, like if we had a pool, right, we have our guy, you and I aren't going to sweat this. Like we're not going to constantly reshop this for $25-$50 a month. Like you just want to know it's done right. There is high customer attachment. And that's the nice thing about this business, which is switching is pretty low. So you finally comp positive for the first time with the changes they did last quarter. They had a plus 6.6% comp. The remaining, the next quarter coming up, they're up against the negative 12.4% comp. The streets at 91 million of EBITDA. Last year they did 81.5. Weather's a big deal too here. Last year, on top of being mispriced, just awful. So you already know weather. I've been tracking the weather. The Northeast is the big swing. Weather in the Northeast has been awesome. So there's two, I was explaining this to somebody yesterday. I'm like, look, you can agree with me or disagree. I think their guidance is likely conservative. I think this new management team came in to beat and raise. But one thing is very clear. The guidance has a variability for weather. And you now know with 100% certainty that this quarter, the weather has been awesome.
Yeah.
And I know they're going to, as much as possible, they're going to beat the street. And so the question on the reflexivity is this, which is you have this levered stub. Yep. Right. They're going to beat, and then the next quarter, they're cash flow positive too. Like, I just feel like this can really rally.
And so when you say really rally, what is that price target? Like it's up 700%
upside. Okay, let's do that. Like, if you can get back, so on 950 stores in 2019, you were doing 160 million of EBITDA. You're back to 950 stores again. All right. Now the chemicals, you're not earning as much. There's been some cost inflation and whatnot, but you have other pieces of your business. You're now in hot tubs, which is about 10% of the business. Your distribution maybe a little bit better, blah, 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 blah. You probably can get back to 175 of EBITDA because you've done cost cutting too. What's the multiple on this business? A fully penetrated, essentially subscription, sticky customer business. That's north of a 10 times multiple. I think this can be a $2 billion business. And if you get to that $2 billion business, the interest isn't that high. You're going to pay down some debt. So call it $2 billion less. At that point, 500 million of debt, maybe less. A 1.5 billion market cap on 10 million shares. That's 150. So I'm sort of, my bookends are 150 upside. The other side of this, is like when the stock was at 5, I said to the CFO, I go, why don't you just issue 250 million bucks at 5, take the share count from 10 to 60, get debt down, and then at 500 million of debt, like you can carry that all day. He seemed incredibly disinterested in that idea. And now the stock's, obviously is higher. Now this is going to come down to, look, how much can they beat? Am I right that they're going to beat? But like in terms of reflexivity, to your point, the higher the stock goes, the math just gets better and better and better. On that same get back to $2 billion valuation business, assuming they do 250 million at 5 and buy down debt at par, that math still gets you to $30 a share. So it's like, in my mind, it's 30 by 150 if I'm right, versus a $10 stock. And from like just a tactical thing, and this is sort of the thing, this is kind of like a poker hand or a blackjack hand where I'm like, I don't know if they're going to get to 2 billion. I don't know how this is going to play out. There's some execution risk. I certainly know that the next card, or I feel strongly that the next card I see, which is earnings for this quarter, I think that's going to be a good card. And if the term loan goes from 40 to 65, 70, the equity goes up to 20, maybe they issue a little, I just, and then you have one more summer quarter after that. Like, this thing can run. You can get away from this without really taking true terminal value risk with a really big number.
So how did you find this? Like, how did this stock surface and hit your radar?
You look through screens, you build a big network, people show me stuff. And that's the other value of having the Substack, having Twitter. I try to keep as many networks as possible, and I'm running screens too. And this thing, the parallel, and we can go to AGL after this.
Yeah.
The thing that I sort of glanced over that I want to make this point, which is there's a million of these equity stubs. And we sort of talked about America's Car Mart, CRMT. And I'm like, well, you had 150 dealerships. Now you've got 95 because you closed a bunch. Your average car that you're selling is $17,000. It's really a subprime thing. Like, if that went away, like, the business quality there, I just don't know if that needs to exist. Yeah. And you're not dealing with great management, blah, 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 blah. Here, you got sticky customers. You have 1.1 billion in revenue that likely goes back to 1.5. Pool Corp, which is more wholesale, does own a competitor. Now it's a franchise model. That's pinch a penny. You've got Home Depot and Lowe's that are in this space now on the chemical side. Would it be worth them to buy, a retailer that's consumer facing? Yeah. I just think your asset quality with that level of revenue and this national, you have the national footprint already built out. You've established the store footprint. You actually over-established it. Now you scaled back. There is a buyer for this business at the right debt load. And there's a reason this would exist. This isn't going to end up in a liquidation. Now, the juice is of people that care. You do have these universes, right? First off, you have all the debt guys. The higher the stock goes, the debt guys are going to be like, oh my God, leveraged stuff. This is just it's sexy. And you can tell this COVID story on normalization. Pool Corp, we didn't talk about, but that stock chart looks eerily similar to this too, from the same overcapacity issue, which is we surged the number of pools in this country grows about 1% a year since the financial crisis. Pre-financial crisis, when the housing boom was happening, we were growing the number of pools 3-4% a year. All right. The only year since the financial crisis that the number of pools in the country grew more than 1% was 2021, when we had all this de-urbanization. So Pool Corp, at Leslie's, everybody else, they surged capacity to meet it, and then it immediately went away. So.
Yeah, Pool Corp, actually, that chart looks pretty good too.
Pool Corp looks really good. Everything I'm saying about Leslie's works for Pool Corp. And that's why
Pool Corp is
back
super
to this COVID normalization thing.
Man.
Yeah. Because it's taken 3-4 years to cycle through. We met a demand surge, was met with supply right at the peak of demand. Then demand comes back a little bit. Now we have deleveraging through the whole system because we got to pull back capacity. Now we get margins collapse. We had cost inflation through the wazoo. Pool Corp's gross margins have actually been really stable at 30% a year. But where they've been crushed is their EBIT margin, which is all that SG&A. They just they got murdered. But that's going to sort of stabilize, and now you're up against easy comps.
Yeah. Well, that seems like a theme in these ideas, and we'll get into healthcare next. But one of these, you talk about inflections, and you're not just buying stuff that's cheap, but stuff that's gonna
all the comps. What am I saying about? We just talked through autos. Now we talk about pools. The story has to make sense for the entire comp set. Otherwise, you just have a fixed point trade, and that's a really good check.
Great point.
Because again, I want to buy value, I want to sell growth. So you got to get comfortable on the value side. Why are we here? And then what's my story from here? And the connecting tissue for all this stuff is COVID wasn't a 1 year thing. It was really, it's 2019 versus today. You had a boom, bust, and then readjustment, and then the move in it. A lot goes without saying. A lot happened. Now we had the Iran war. A lot's happened, a lot of dislocation. And when dislocation goes away, things can sort of work their way through.
So last
point on Leslie that I'll make everything I just said, I said at the start about oil and interest rates. Super levered company, you take the 10-year treasury, oil goes to 50. Where's the 10-year treasury going to go? Down to 4, and it makes, refinancing debt a heck of a lot easier.
Yeah. So pivoting to healthcare now, and we'll use AGL as an example, but I do want to discuss TOI. But AGL is another one, 2021 highs.
$11 billion IPO in 2021.
Yeah, it's down 90. It was at one point down 99%.
Over 1,000 a share, split adjusted, down to 8.
Yeah. And so now here we are, though, from 8, we're up to, or actually from the lows. I mean, shoot, the lows here, like, yes, call it $7. Now we're up 1,500%, up to $107. So like crazy ride, right? So like when did you find this idea, and then when did you start accumulating?
So I've been touching healthcare most of my career. I made a bunch of money, and then I really torched a bunch of money in 21 on these value-based healthcare names, and I kept following them and whatnot. But let me tell the story a little bit more high level. Okay. Healthcare cost inflation. If you look at Humana, United Healthcare, whatnot, pre-COVID was running, 4 to 6% per year. Okay. Then we had a year, 2020, you couldn't go to a hospital. So MLRs, medical loss ratios for the insurers, looked awesome because 35% of healthcare spending happens at hospitals. So if nobody's going to the hospital, we don't have medical expenses. And so we print a bunch of money. And then AGL was one of the ones that went public. Value-based care names, they take they provide care, and they take risk on providing a lower MLR. And their argument is by giving better care, we can lower the MLRs, and we want a share of that. All these things came public: Oak Street Health, Kano, CareMax, Privia, One Medical. Oh man, I could go down the list. Alignment Healthcare. There's a lot of them that went public because they all printed money in 2020, because MLRs at the national level typically are about 90% across, Medicare Advantage pools. When you do all the math for the insurance, they were like 70 that year because nobody went to the hospital. Then 2021, we start going back to hospitals with an elderly population that we just gave. I'll give the COVID conspiracy theorists their due. A potentially poisonous shot we injected with you. But behavior changed as well. We didn't go to a hospital for a year, so we did not early diagnose a lot of stuff.
Yeah.
Healthcare cost and then we add in all the inflationary pressures across the system, right? All of a sudden, healthcare cost inflation goes from 3, 4, 5% to 7, 8, 9% a year. 21 and 22. Rates are reflecting the 2020 awesome year. Rates didn't reset up high enough. So now you're just lighting money on fire. Then we've got to start setting rates higher, which we've done like this year, this current year, the CMS, Centers for Medicare and Medicaid, the baseline rate increase is like 7.5%. So we're finally catching up. But what are we seeing at the start of 2026? Lo and behold, oh wow, it's a good Q1. It's a good trend here. We're way under cost trend. Now, so we'll see what they report in Q2. The non-deal roadshows and the conference circuit the last few weeks, the big health insurers have been saying it's not just a good trend here. Maybe trend's just going to go back to what it was pre-COVID.
Yeah.
When rates are still reflecting a ton. So that's like the big high level story. With value-based care specifically, most of these names went bankrupt or were bought out. So CVS bought Oak Street Health. It would have gone under had they not bought it. Kano, CareMax, gone. One Medical was bought by Amazon. I'm sure it's going to get wound down. This one just got just losses upon losses upon losses. Now, what AGL does specifically, they partner with primary care providers. They do a 60-40 partnership in favor of AGL where they take the value-based risk and they coordinate all the third-party medical spend. So you're going to go to the hospital, you're going to go to a specialist. They do all of that for 60% of the economics. Because they're partnering with primary care groups in state, there's no CapEx really. So they're getting the patients and they're sharing the economics. And that's the attractiveness of the model. You get massive scale. You've got about 600,000 Medicare Advantage members. Okay. What AGL did, and this restructuring started 2 years ago, was they started going to the health insurers that they partner with, and they said, I'm going to go bankrupt unless you give me rate. And on top of that, I'm not taking MLR risk on the whole suite of medical spend. I'm only going to take MLR risk on the stuff I'm actually touching.
Yeah.
So that they carved out Part D, which is oncology drugs. They carved out a lot of stuff. And basically what those negotiations yielded was the big health plans acknowledge that AGL and the other people who do what AGL does help them get stars ratings. If you get 4 or 5 stars from CMS, you get 500 basis points more on your rate, your Medicare Advantage premium from the government. Okay. The second thing they do is broadly, without an AGL, really doing the blocking and tackling at the patient level with the physician, Humana, United Health would deliver probably across the population about a 90 MLR. With AGL or their competitors, they probably can get that down to an 86. So give me values, give me some of the 500 basis points for the star ratings, give me some for what of the value I'm actually providing. Let's carve out everything else. So the standard deviation of my earnings is going to go way down. That's not really appreciated yet. The big thing that is appreciated is these guys all got enough rate to go positive. So AGL, you had this just unbelievable nightmare convergence of things, which is, this thing never should have traded at 8. Okay, they did a reverse split that shook out a lot of people. The restructuring had been going on for a year, so you had all these first wave and second wave guys come in and get their face blown up. Yep. They left. Value-based care has just been a wasteland for so long, and medical trends just been, gone for so long. People thought this business was just a zero. So at the bottom, you entered this year with $290 million of cash, $40 million of debt. You thought you were going to burn, $370 million of cash, 370, not 270. So you started this year with 370 of cash. You thought you were going to, prior your claims, you thought you still owed 250. So that brings your cash down to about 120, 125 by year end 26, what they told you. You got $40 million of debt. So call it 85 million. And they thought they could do EBITDA 0 this year and go cash flow positive next year. And you could buy that business with, this is the funny part, with $5.5 billion of revenue. If they can get it to a 10% margin, you're like, okay, which is what it probably should be. That's 550. Anyway, at the bottom, this thing had net cash and you had, 8 times 16. What is that? I mean, under $100 million market cap. I mean, I was buying this thing for under $200 million, 5.5 billion of revenue. And, you do the work and you're like, if these people are telling half the truth, this could be an $11 billion business again. If you really turned it around, because you've carved out all the risks, you got rate upside. You also have a sponsor alignment. So CD&R, Clayton, Dublier, and Rice took it public. They still own 25% of the business. So they had a reason to care. And that was something I glanced over with Leslie too, which is critically important, which is Leslie has a 40% equity holder in this Chicago mutual fund. Having the equity sponsor is just it's critically important. Pro, which I'm pissed about, the sponsors screwed me because they wanted to just take their money and run and please their LPs. But anyway, back to AGL. So I had the sponsor there. I had the numbers, and then so we got involved at 8 because I thought I was like, this is just too interesting. And I think on the reverse split alone, this is probably going to rip. It went to the 20s, and then they gave it away. And this is when conviction goes to 120% from like 50-50. They didn't have a CEO. The executive chairman was running the business with the CFO. They hired the CEO, and I knew they hired this guy, and I was like, oh, let's see what the comp plan is. With the stock at 25 a share, they hired this guy. His performance stock vested in 3 tiers. The tiers struck at 50, 100, and 150. And you sit back for a second. You're like, performance comp plans, for those people who don't know, tier 1 and tier 2 are supposed to be gimmies. Tier 3 is like, that's supposed to be hard. What had to have happened in that, and you got the CEO comp before you got first quarter earnings. And I'm like, but you knew the CEO had the earnings. You're like, oh my God, what is that negotiation like? That they ended up that the low end of the performance stock plan is up 100%. I was like 100. They're being. I was like, I was like every share they're gonna beat, and they the stock ripped on earnings. I mean, it's just so rare that they give it away like that.
So is that and sorry to interrupt, is that a core part of how you identify potential ideas, is looking at maybe it's PSUs, RSUs, and then like what's your process for
really relevant in this? It's also relevant in other situations too. Like when a company gets distressed, you either get a new comp plan to realign management.
Okay.
This was like insane that you got a CEO at the bottom turning over, and when it happened, I'm like screaming at people. I'm like, we won. So, and like it wasn't hard either because the company was guiding. You just had to believe the guide. And nobody was looking at it because the space had been so obliterated for 5 years. Yeah. Now, where the COVID normalization thing dawned on me was once they started talking, early in this quarter about the trend, it not being a good trend year, but like the trend is carried on. And I was like, oh, we're just going to go back to pre-COVID. And then you sort of connect the dots to other things because it was like I'm looking at L Pro and the auto thing. I'm like, this is COVID. This is all COVID normalization. And then you start really getting in an upside case. So like going for AGL, you got 5.5 billion in revenue. They're growing this year. That's the other thing. All these things that, EVH, we're not going to have time to go through all these things. EVH is growing. That's Evelyn Health went from 34 to 2. It's now 5. Adding 6 times levered, 2.5 turns of equity layer. That's a nice levered stub too. Yeah. But all these things, you get value, and number one, like the value side of it, and then the growth side for AGL, just to put a fine point on it. One, I have way better contract structure, which means multiple is going to be higher. I have acknowledgement from my customers, the big healthcare payers, that I need to exist. We went back to them over the last 2 years. We're like, I'm going bankrupt if you don't give me rate. They gave you rate and they gave you better contract structure. What does that mean for your terminal value multiple? Like a lot more. You're signing new contracts. You're growing. Your margin's going to flow through, and then you add COVID normalization. So for AGL, the stupid math is you're currently 5.5 billion, maybe 5.7 of revenue this year. Your peak revenue is 6.2. I think they can easily it's so crazy. They only have 600,000 members. I think it's 40 million. God, we can look this up. I forget what the total Medicare Advantage population is. It's big. But this can be a 15 billion revenue company and a 10% margin. You can be 1.5 billion of EBITDA at least 10 times. That's 15 billion because there's no CapEx.
Right.
And you're getting, and all of a sudden you're back to the IPO valuation of 11 billion and then some. I mean, you might this can just be an epic monster. And so back to sort of what we said at the start with the ASTS and Nebius. So with AGL, the first thing that grabbed my attention, 5.5 billion of revenue, and the market cap is, buying it for an EV of 160. I mean, the management team's awesome. It's the quality of a management team that runs a 5.5 billion revenue business. You had a great financial sponsor with CD&R. You just had all these elements there, and now you have a growth story. So it's my first buy was at, was at $8. I really sized up in the 20s after the CEO thing because my conviction went to 100%. And my last ad was like $55 a share.
Wow. What a ride.
Yeah. It's
And do you just play these through common stock? You don't buy options or anything like that?
I just there's plenty of juice with common, and
I guess especially if you're buying these like leveraged stubs too. It's like they're basically call options.
Yeah. And look, the thing that I can't do right, you put me in a market neutral context, I can run hot and I can run cold, but I'm going to get shaken out, and because it really doesn't agree with how I invest and how I think about the world. Okay. Because you don't look, AGL played out. I mean, I think there's a lot more meat on the bone, but it's 2.5 months and I've, more than 10x'd. from my, so, like,
It's not a bad
it's not
IRR.
lost on me that like that's a once in, if that's a once in 10-year occurrence on a major position, you're winning. TOI, I'll go back to that one. Like, I put it like from the bottom at like 11 cents. I really, got involved sort of at 20 cents and I sized up at 70. It ran up to $3 and then it traded for a year and a quarter between 3 and 4.75, bottoming this spring during the war at 2.45. And I think TOI can go, I've got a 35-page note on my Substack about it, and I've sort of talked it to death, but they're basically an oncology drug dealer attached to oncology clinics where they'll give you the IVs, but most of the money they make is giving you the oral oncology drugs. That one I think can be 30. That one's grown revenue from, they're going to do, let's see, I think it's 600 this year. The goal is to get, I think it's about 600. They've been growing revenue. The pharmacy revenue has been growing at about 40% a year. The whole company grows about 30% a year. That one, you're hoping to get to $1 billion in revenue by 2030. Okay. And I think that can eventually be $3 billion, but like, it's just a smaller company. There's more blocking and tackling. So you want it, like, how many people could have gotten shaken out at TOI? And like, look, I haven't been proved right. Like I've made a lot of money, but like I'm a liquid. Like I need this thing to go, to 10. I could just crush this thing if I wanted to, but some of these take a lot of time. And so going back to the options, like, look, these are also less liquid stocks. So your bid ask spread on the options, how much are you going to get?
Yeah. Yeah, it's a good point. So let's end the discussion then with giving you this challenge of, let's say you had to start clean, right? Let's give you like this portfolio challenge where you fund it with, $10,000-$20,000, and your goal is to recreate a portfolio that you think can do really, really well. And you can't invest in any of the names that you already own or have made, tons of money in. How would you go about finding the next batch of opportunities? Like, what's the daily process for Judd in finding these and then comping them against the opportunity set?
Sure. So we do, like, I put out something called the 2-year holds list, and it's like the core product of my Substack. Okay. And what I say that the 2-year holds list is, this assumes you're running $50 million. And the rule is, I'm saying I'm comfortable giving you the recommendation, not talking to you for 2 years, and I'm comfortable I'm not going to blow you off. And this was a choice I had to make with my Substack, which is other people give trading ideas constantly. They're in, they're out. And I really didn't want that pressure at all. It's not priced for that. I charge $200 a year. And if you want to join, great. If not, so be it. I wanted something that like I got value of, and I didn't have the pressure of, I'm giving you trade recommendations. I'm in, I'm out, and I need to tell you. Like, I think that's a very hard thing to do. So I came up with the 2-year holds list a couple months ago, and I update that about every quarter. And it's things that I think the hurdle rate that I say, is I think you're going to do 50% or better on a 2-year basis. That's the hurdle rate. And it's going to be big enough. It's going to be liquid enough. So the number one thing on that is Navios, which is a shipping company trading at 50% of NAV.
So funny. A 2-year hold is a Greek shipping company.
Yeah, but that's another one. Do you think about the setup? Shipping is really having a big inflection. It's a shipping conglomerate. It's just really like shipping has rationalized. You had massive overbuilding, and you now have this sweet spot where Angeliki, the CEO, she's doing a bunch of new build, more so than anybody else. And because she's the only one building, relatively speaking, residual prices are really high. So she's selling 20-year-old vessels that are right in the middle of their special survey for 70% of new build cost, recycling that capital. It's actually insane.
Yeah.
You're not that levered, relatively speaking. The stock's at $70. I think in a cycle, it's probably going to do 13 per share of cash flow this year. It is a shipping company, so there is, they have to recycle. It probably does $25-$30 a share of earnings in a real cycle. You might be buying for 2 times earnings. The stock can go to $250.
Mm-hmm.
Porch is one we didn't talk about. It's like, it was a SPAC. Now it's in this insurance company. Apollo is more liquid. I've talked at length. That's my way to play sort of private credit distress. I think that's most likely an unlevered double. So Apollo, I think it's 125 a share today. The math on that is then Athene is $8 a share of earnings. And then everything else is another $8 to $9 a share of earnings. So it's, it's about, a $16 earner. Now Athene, there's a lot of back and forth on that where people are like, I don't like it. It's too levered, blah, blah, blah. Look, 40% of Apollo's AUM is now captive from Athene. It's going to keep going up. I think it's got a chance to be a Berkshire Hathaway. And once they're going to get to a scale where they're going to stop raising big private equity funds and they're going to realize principally investing their own money in their distressed private equity deals is the right way to go. And I think that's going to be a great evolution. I think you can get to 250 a share without a lot of heroics there. And I think that's a good place to play. I've got a whole list on my site and I just encourage people to come out, but my core product, we write up a lot of names, we speak a lot of names, and, I'm not sitting here telling people buy this or buy that. I'm putting, I very much appreciate that what's interesting to me isn't necessarily interesting to everybody. And one of the things that I took away from sort of my hedge fund career and my consulting career before I did the Substack is, you work for a fund. The PM's only going to care maybe 10% of the time, maybe 5% of the time they're actually going to put it on. So you don't know what's going to resonate with people. And really everybody, I hope they end up with the portfolio. Number one, that they understand, especially it's a name that's coming from me. I hope they understand all the risk. We can take it to the next level, but because you really need to own your own risk and you need to have conviction on it, right? Yeah.
No, I appreciate it. I always enjoy these conversations because I learn something new every time. And, you always, whenever I talk to you, I always end up looking, I dust the cobwebs off the Left 4 Dead and Cheap versus Own History screens where I'm just looking through stuff that's bombed out, because the special sauce, right, is finding those AGLs at 5, finding the TOIs at 1, finding the Leslies at 2. It's nice to find them at 10 if you think they're going to 65, but it'd be great to find them at 2 if to find them at 2 before they go to 8, right? Obviously.
Yeah.
So
there's always another trade. That's the other thing. The older I get, the more it's like it's easier to let go and just shake off when you miss stuff, because it's like the number one cure. I guess this is where we can leave it, which is I've had a lot of ups and downs in my career, and a lot of friends who have ups and downs, and I've now become for my friend group, like the guy to call when you're going through a tough time, because I've always climbed my way out, and it's like my number one. If I write something on my board, it's like the number one cure for every slump is finding the next trade and the confidence to know that it's going to be there. You're going to find the next one, and it's just.
Yeah, I like that. All it takes is one. Awesome. Judd, thanks so much, man. I appreciate it.
Thank you for having me. This is great.